What's going on, everyone? In this video, we're going to talk about three assets to buy if you want to retire early. Now, in this video, I'm going to outline that the three distinct financial assets to replace your salary in retirement. Now, this emphasizes the importance of building a income flow or the pipe rather than relying on infinite saving pot, the bucket. So I argue that the traditional 4% rule is broken for longer retirement and I'll provide you specific reason why it doesn't really help you and doesn't really maximize the efficiency and tax advantage. Now, here's the issues that I see that everyone does. Everyone just does the 4% rule because that's the method most financial advisors tell you. But at the end of the day, it's not going to help you retire early. So this video is really emphasizing on trying to get you to build assets so you can retire early. Now, here's the thing I got to tell you. I spend a lot of time studying about markets, research, real estate to find the best assets for you in this situation. Now, I personally own every one of these assets and it helped me retire early. Now, I am working full time because I do enjoy my work. I like helping people. So at the end of the day, I could retire, but I don't. So let's get into this video. So number one assets I recommend is the liquid portfolio. And this is the first thing you have to do. This is your structural foundation. This is a must be built first. There's no other way to say it that you need money and you need liquid emergency fund so that you can reduce the sequential of return risk. And this allows your investment in other assets that you might be over leveraged on and without causing you disruption. And what do I mean by this? It means you need money in your account, plain and simple. Now, besides your emergency fund, which is 3 to 6 months, if you're retired, I recommend you have 9 months because you're retired and you don't know what's going to happen. And how much should you have in there? Well, in this liquid portfolio, I recommend you have a 9 month emergency fund plus a year worth of expenses to live without touching your portfolio. Why do I recommend that much money? Well, I give you an example. If the market is bad, you can live without withdrawing any money for a year because you have that year set aside already. How much will that be? Well, if you live off of $50,000 a year, that means your 9 months of expenses is roughly about $40,000. And your year of expenses is of $50,000. So you need to have an account $90,000 in this liquid portfolio. Now, that's a lot of money to set aside for your emergency, for your liquid portfolio. But at the end of the day, this liquid portfolio will save you from withdrawing and save you for anything to come up. Now, the next one I recommend you to buy is real estate. Asset number 2. Rental properties generate reliable cash flow. And the key is conservative finance and buying for cash flow, not just for appreciation. So the rental portfolio can cover a significant portion of your expenses. So I give you an example. You buy 4 properties and you're cash flowing $2,000 a month from those 4 properties. That's after everything, all your expenses. Well, that's $24,000 a year. That will help cover a lot of your expenses. Now, what I do recommend on this asset real estate before you retire is to have them paid off. Having one paid off house at 100% giving you $2,000 to $2,500 a month gives you $24,000 a year on the low end. Now, and you don't have the risk of the renter. Now, if you don't like that, then yes, you can do the like that. You can still do the renter and the mortgage with a low percentage of interest. And you remember, you need to focus on cash flow, not really appreciation. And that is my second recommendation. Now, number 3 assets I recommend is dividend stocks. Why do I recommend dividend stocks? Well, if you build a portfolio and do a 2.5% to 4% dividend yield a year, and you have 200,000, 300,000, that roughly will give you $1,000 a month. That's great, right? So if you have a dividend income and you only withdraw from the account the dividend payments, it's a great way to have a secondary income. So the asset increase income stream over time. When the stock value goes up, if you pick a good stock, your percentage you get paid out every year will go higher. And that is the main thing I tell you. And those are the 3 assets I recommend you to buy and the reasons why. Now, how can you get all this done? That's the other question. So, not going to be easy, for one. First of all, buying rental houses and investing in dividend stock is going to take a while for you to do this. So you have to be consistently investing in dividend stocks and actively saving for rental properties. That's the only way you really can do this. Now, the key difference is the bucket strategy versus the pipe mentality. So if you're worried about this, remember the bucket strategy is you save a lot of money in a 401k over time and you withdraw from at the end. With this pipeline, you potentially get flow of money now so you don't have to worry about it later. So you can slowly get yourself in the situation. So that is why I like this. So you can build up this income, and when you're ready to withdraw the money, you can transfer to the proper. You can retire whenever your money is ready. So you can keep allowing it to snowball. And then automatically at 50, 60, you can start using that money and stop reinvesting it. That's why I like the pipeline. And the other thing is tax optimization. You can pay 0 on long-term capital gain taxes and not worry about federal taxes and everything else if you do this right. Because if you're in real estate, you don't get tax on it if you follow all the guidelines. Same thing with dividend and stocks. You don't get taxed on a certain amount. So this really helps you out for not paying taxes. This is why I like this style better. So if you want to retire at 55 and not worry about all that, this is what I recommend to buy for the 3 assets. So like and subscribe to my video. That's all I got for you.